Hello, everyone. My name is Victor Lai with BCM, and welcome to part 4 of Learn About Stocks. In this video, we'll take a closer look at fundamental analysis. In part 3, we looked at different ways to analyze stocks. We said that both technical and fundamental approaches work, but at BCM, fundamental analysis is our primary approach. Now, that's not because fundamental analysis is better. It's just that it fits our style of investing. So we are long-term, value-oriented investors, and fundamental analysis works well for that purpose. So here is the generic framework that we've been looking at. Please remember, this is not a standard template. It's just one simple and generic example that I made up to help us think about how to look at stocks in an organized way. So working off of this framework, we're going to start with quantitative research. This is a broad term that covers a lot of things. But when it comes to analyzing stocks, it normally involves financial analysis, like going through a company's financial statements. There are different ways to perform that financial analysis, but we're just going to use a very simple approach called ratio analysis. This is like a quick way to get a basic read on company financials. It's certainly not a comprehensive approach, but it's a good place to start. And anyways, regardless of how we do the analysis, there really are just a handful of things that we want to evaluate. People can call them different things, but I use the following labels. I call them financial health, profitability, growth, and valuation. We're going to start with financial health. This just tells us how strong a company's finances are. Financial health is really important for stock investors because common stock typically has the lowest priority in the capital structure. I'll explain what that means. Now, remember in part 1, we talked about the different ways that a company can raise capital. It can borrow money, which is debt, or it can sell stock, which is equity. Well, capital structure just tells us how much debt and equity a company has. It's also called a capital stack. This is a generic example of a capital stack. Now, you can see that debt is shown in blue and equity is shown in red. There are a couple of things that we should notice. First, notice that debt is higher in the stack than equity. That's really important because if a company gets into trouble, if it goes bankrupt, investors at the top of the stack are the first in line to get their money back. So they have the highest priority in terms of recovering their investments. Second, notice that common stock is at the very bottom of the stack. That means common stockholders have the lowest priority to recover their investments. So as a common stockholder, we really want to know that a company is financially healthy, and that it is not at risk of going bankrupt. Because if it does go bankrupt, if it does go out of business, we are last in line to get our money back, which means we're probably not going to get our money back. Now, here are a couple of popular and common ratios we can use for a quick overview of a company's financial health. The first one is the debt to equity ratio. This tells us how much debt or leverage a company is using. It's calculated as debt divided by equity. Remember in part 2, we learned that all that info can be found on the balance sheet. So as an example, if a company has $100 of debt and $100 of equity, then its debt to equity ratio is just 1. The higher the debt to equity ratio is, the more risky it is for stock investors. Because remember, debt is above equity in the stack. So if there's a lot of debt up there, then stock investors will likely be wiped out if the company goes bankrupt. The second ratio is called the current ratio. This tells us how liquid a company's finances are. It's calculated as current assets divided by current liabilities. All this info is also found on the balance sheet. So if we have current assets of 200 and current liabilities of 100, then the current ratio is 2. The lower the current ratio is, the riskier it is for stock investors. And that's because current liabilities are like short-term bills, whereas current assets are like the liquid assets such as cash. And of course, we always want to make sure we have enough cash to pay our bills, because if we don't, then that's how we can go bankrupt. Okay. Next, moving on, we have profitability. At the end of the day, all companies are in business to make profits. They have to stay in business. In part two, we saw how the creation of profits can actually affect the stock price. And of course, it can also affect financial health. Here are two financial ratios that can help us evaluate profitability. The first one is profit margin. This shows us how profitable a company is. It's calculated as just net income divided by revenue, both of which are found on the income statement. So if we have $1,000 in revenue and 100 in net income, then our profit margin is 10%. Obviously, higher profit margins are good, and stock investors should want that. The second ratio is return on equity, or ROE. It's calculated as net income divided by equity. Notice this is a cross-statement ratio because net income is on the income statement while equity comes from the balance sheet. Not everybody calls ROE a profitability ratio. I've heard it called all sorts of different things. But I think net income is a measure of profitability, and ROE then is really a measure of profitability for stock investors. But whatever we want to call it, stock investors should want high ROE. All right, next, we move on to growth. In addition to being healthy and profitable, we also want companies to grow. Two common measures of growth are revenue and earnings growth. Both items are found on the income statement. So if a company has $1,000 in revenue one year and then $1,200 the next, then the annual growth rate is 20%. This works the same, of course, for earnings. Higher growth rates are obviously better than lower growth rates, generally speaking. One thing I want to point out here is that something that's different with these ratios is the concept of time. So up until this point, most of the ratios we looked at, we're looking at things at one point in time. So for example, what is debt to equity right now? What is the profit margin right now? Well, growth is measuring things over time. How are they changing from one period to the next? And that's really important because we should be evaluating all financials over time, whether we're looking at debt or revenue. We should want to look at how are those things changing over time. Are they getting better or worse? Is the trend getting better or worse? So the trend in those values is just as important as what those values are. Last but not least is valuation. Valuation helps us understand if prices are high or low. Two very popular financial ratios are called the price to earnings ratio and the price to book ratio. These are also sometimes called price multiples. And these things just give us a quick estimate of what valuation looks like. So for the price to earnings multiple, it's calculated as the current stock price divided by the earnings per share over the last 12 months. So for example, if a stock has a price of 100 and it has earnings of $5 per share, then the PE is just 20. Right? This basically is telling us that the stock is priced at 20 times last year's earnings. So the higher the PE is, the more expensive the stock is, and vice versa. The second multiple is price to book. This is calculated as the current stock price divided by the current book value per share. So a market price of 100 divided by a book value per share of 50 would equal a price to book of 2. This basically tells us that the stock is priced at 2 times its book value. Again, the higher the PB is, the more expensive the stock is, and vice versa. Now, we just rifled through a whole bunch of different ratios. Don't worry if you didn't get everything, because in the next video, we'll walk through a real-world example that will help clarify everything. Something to keep in mind is that there are hundreds of different ratios we can use to measure all kinds of different things. It's really easy to get caught up trying to memorize all the different formulas, but don't worry about doing that. It's actually much more important just to remember what we're trying to do. Our goal is to just understand the companies, is just to understand the company, right? Things like financial health, profitability, growth, and valuation. What do those things look like right now, and how are they changing over time? The next part in our framework is qualitative research. As we already know, this is subjective analysis of information that cannot be easily quantified. There's lots of different qualitative factors we could consider, and they will differ depending on the company and the industry. We're just going to look at a few generic examples. Just remember that ultimately our goal with this is just to understand the company, its business, and the different risks and opportunities that it's facing. So one qualitative area to look at would be, a company's business model and its competitive position. At the most basic level, we want to understand how a company makes money, right? What are the different sources of revenue and profit? Digging deeper, we could look at how does a company create value? At the end of the day, the more value customers see in a product or service, the more they want to buy, right? We also want to look at how well a company stacks up against its competition. The more competitive an industry is, the more important this is going to be. So just look at the traditional brick and mortar retail industry. It's super competitive. Many companies have failed, and many companies are failing right now. But a company like Walmart has been able to remain competitive because it's a low-cost leader. Its size, its scale, and its business model have enabled it to remain profitable, while others have not. Other companies can compete on things like differentiation. So look at Coca-Cola. It has a really strong brand recognition. We can go basically, to any restaurant in the world and probably order a Coke by name, but we can't really do that with something like RC Cola, right? So that's a very good example of a qualitative, intangible factor. It's hard to quantify, but it obviously has real value, and we need to look at it and we need to analyze it from a qualitative perspective. Okay, something else to consider are risks and opportunities. This is just a really broad label that covers a lot of different things. But basically, we want to know what are the key drivers and challenges that a business is facing, things that are going to affect its success. Some factors are external and are beyond a company's control. So, for example, the coal mining industry, right? It's been in decline for many years, and it's likely to continue doing that as we move towards renewable energy. That's an important external risk that would be super relevant to a mining company like BHP Billiton, right? But at the same time, this is also a good external opportunity for a company that's involved in alternative energy, right? So companies like SunPower or even Tesla now, since it's acquired Solar City, the clean energy trend is like a rising tide that can lift all boats in an industry. Now, at the same time, companies also have to deal with internal risks and opportunities. So, going back to Tesla again, Tesla burns through a lot of cash because of R&D and producing its cars. So, running out of cash is a key risk that is internal and specific to Tesla. It doesn't matter how high the tide rises for an industry. If we have a leaky boat, we can still sink. And that brings us to the last point, which is, what is a company doing to address the risks and opportunities that it faces? Is BHP just sitting around waiting for coal mining to go extinct, or is it diversifying away from coal and reinvesting in other opportunities? Is Tesla cutting costs and improving cash flow, or is it just selling more stock and borrowing more money? Evaluating how a company addresses risks and opportunities can give us an idea of where that company is headed. All right, so the last qualitative thing we're going to look at is management and corporate governance. For example, what special experience does a management team bring to the table? How well is the company being managed? And it's not just about being profitable and representing shareholder interests, but something else we can look at is, does the company have a healthy corporate culture? Look at Wells Fargo as a recent example, it is profitable. But turns out that management also created an aggressive sales culture that led to unethical behavior and fraud that hurt customers. And of course, that also hurt the stock price and its shareholders. So, policies, procedures, and culture that management creates can really affect a company's performance as well as its stocks. There are many other qualitative things that we can consider. Really, there's too many to list, but whatever things we're looking at, here are some sources for finding the information. We mentioned before that public company filings are a good place to look. We can also listen into quarterly earnings calls that many companies host. Transcripts of the calls are available all over the internet, and sometimes companies will even post the replays or transcripts on their websites. And in fact, company websites themselves can be a good source of information. We can learn a lot about a company, and oftentimes there are marketing materials or presentations that can be downloaded. Just keep in mind, though, that type of material is obviously created to put the company in a good light. They're not going to be talking about bad things in those types of materials, obviously. One other source you can look at are analyst reports. If you have a brokerage account, brokers usually will provide stock reports from multiple sources. When you read through those things, just read them with a grain of salt, and remember that reports aren't always going to be objective. You have to kind of consider the source, who is creating it. One way around this is just to purchase research from a credible independent source that is going to be objective. Okay, so we are now at the last part of the framework. We at this point we have a good idea of what we like and don't like about a company. Now, in order to form an opinion, a final opinion, we need to know how much we think the stock is worth. So analysts typically will estimate a current fair value for the stock, and they'll also estimate like a target price. Looking forward, usually it's like a 12-month target or something like that. However it's done, the point is that we just need to decide what we are willing to pay for the stock. And there's lots of different ways to do that. They can get very complicated, but as usual, we're going to keep things as simple as possible. One simple approach is to use relative valuation and price ratios. Here's an example with the price to earnings ratio. Remember, PE is just price per share divided by earnings per share. So if stock price is 100 and earnings per share is $5, that means investors are paying 20 times company's earnings, a PE of 20. Now, is that high or is that low? Well, the answer is it depends. It depends on what people would normally pay for this stock or other similar stocks. So, if the average PE for the stock historically has been around 30, and the average PE in the industry is around 35, we might say that a PE of 20 looks low, right? The point is we need to compare the stock's price ratios to what we consider is normal and fair, and that allows us to gauge a sense of relative valuation. So price ratios and financial data, they're pretty straightforward. They're black and white. But notice there is quite a bit of subjectivity with evaluating the numbers, right? So let's say a PE of 20 looks relatively low. We decide it looks relatively low. Now we have to ask, why is it low? Right? Is the company not doing well? Are there certain risks that are being priced into the stock? Are there reasons? Are there legitimate reasons maybe this company is falling behind its peers? So if that's the case, then maybe 20 is justified. Maybe it's not even low enough. Right? So the point is, a lot of this is going to be based on judgment. And honestly, that just comes with time and experience. The more we do this, the more we practice, the more familiar all of this will become. All right, the last thing we're going to look at is how do we use relative valuation to estimate fair value. So let's say we decide that 20 is a fair PE for stock ABC. In other words, we think people are willing to pay 20 times ABC's earnings. So if ABC reports $5 earnings per share, then we can say the fair price for ABC is 20 times 5, which is $100. So that's our fair value estimate for the stock. So if the stock were trading at $50, we might say, well, it looks cheap. And if it's trading at 150, then we'd say it looks expensive. That's it, right? Of course, this is a very simple example. Typically, we're going to use multiple valuation measures to compare and contrast. And again, relative valuation itself is not a precise or comprehensive approach. It's really just designed to help us get a quick and rough estimate of valuation. All right, so in summary, we went over quite a few things. A basic fundamental framework for stock analysis is going to involve qualitative and qualitative research. And of course, the third part would be forming an opinion on the stock. Quantitative research focuses on things like financial analysis, and we looked at a simple form of that called ratio analysis. Qualitative research involves subjective analysis. It's less clearly defined, and it's really based on things like judgment, which ultimately comes from time and experience. Forming an opinion on a stock involves developing an estimate of what we think the stock is worth, and combining that with other information, we can decide whether we want to buy or sell a stock. So that completes part 4 of this series. In part 5, we're going to walk through a real-world example that will really help bring everything together. If you have questions or if you need help with your investments, feel free to contact us through this page. Or you can also find us on Facebook, Twitter, and LinkedIn. All the links are in the description below. We try to share useful information every month. So if you subscribe to our pages, we'll keep you up to date on new content. Thanks for watching, and please stay tuned for some additional information about this video.